Italy to pay up to 17 billion euros to deal with two troubled banks. Milan, Rome. Italy began winning up two failed regional banks on Sunday in a deal that could cost the state up to 17 billion euros, about 19 billion US dollars, and will leave the leaders' assets in the hands of the nation's biggest retail bank, Intesa Sanpaolo. The government will pay 5.2 billion euros to Intesa and give it guarantees of up to 12 billion euros so that it will take up over the remains of Popolare di Vincita and the Veneto Banca, which collapsed after years of mismanagement and poor lending. Economy Minister Pier Carlo Padoan said the total funds mobilized by the state would be for up to 17 billion euros, 3 times more than had initially been estimated to recapitalize the banks with public money. The deal approved by the European Commission allows Italy to solve a banking crisis on its own terms, ensuring the two Veneto lenders are not wound down under potentially tougher European rules. The cost for taxpayers, however, is hefty. Those who criticize us should say what a better alternative would have been. I can't see it. Padoan told reporters. After the government spent the weekend drafting an emergency decree to liquidate the two banks. The decree effectively means that the Veneto Bank's branches and employees will be part of Intesa Sanpaolo by Monday morning, a move designed to avoid the potential run on deposits that could have spread chaos across the whole banking industry. The decree will have to be voted into law by Parliament within 60 days. Under the plan, the bank's sour loans, as well as legal risks stemming from a mis-selling scandal, will be moved to a bad bank, partly financed by the state. Junior bondholders and the shareholders in the two banks will suffer losses, but senior bonds and the depositors will be protected. Padoan said that on top of the 5.2 billion euros payment to Intesa, which includes 1.3 billion euros to cover job cuts, the state will offer guarantees to fund the potential losses arising from the due diligence of the two banks soured and the risky loans. A treasury source said the government estimated that the total 12 billion euros in guarantees would translate into a fair value exposure of just 400 million euros for the state, but did not explain how it arrived at that figure. The EU Commission also said in a statement that the net cost to the Italian state will be much lower than the nominal amounts of the measures provided. It too did not explain. Banking analysts, however, said that the state could ultimately be on the hook for up to 17 billion euros, even though some value could be salvaged once the soured loans were fully analyzed, limiting the final bill for taxpayers. Tough conditions. Intesa Sanpaolo, Italy's best capitalized large bank, said last week it was open to purchasing the rump of the good assets for €1 on condition. Italy's government passed a decree agreeing to shoulder the cost of winding down the two banks. Setting tough conditions for the deal, Intesa CEO Carlo Mencina has insisted that his bank's capital ratios and the dividend policy will not be affected by the transaction. Without Intesa Sanpaolo's offer, the only significant one submitted at the auction held by the government, the crisis of the two banks would have had a serious impact on the whole Italian banking system. Messina said in a statement on Sunday. The European Central Bank, which supervises the two lenders based in the country's rich northeastern Veneto region, had declared on Friday that they were failing or likely to fail, setting in motion the process that led to them being wound down. After months of tense negotiations between Rome and EU regulators, Italy has being allowed to use national insolvency procedures rather than EU rules designed to prevent the use of state money to deal with bank crises.